996%. That's how much we made on our last options trade in the space of only 6 weeks. Now, you might be wondering, how can someone make such enormous returns in such a short space of time? Well, you've come to the right place. We'll discuss how we got the idea, how we structured it, and eventually we'll give you a detailed breakdown of the actual trading strategy, which involves all the trading actions, and we'll also go step by step in explaining exactly why we take certain actions and what we're trying to achieve with them. At the Financial Traders Hub, this is basically what we try to teach our members. So make sure you watch the video carefully till the very end. You will learn a lot irrespective of where you are as a trader. If you're a beginner trader, you'll absolutely love it. If you've been trading the financial markets for a number of years and not had consistent success, you'll absolutely love the video because you'll understand exactly what are the missing links that are preventing you from achieving such enormous returns in the markets. We've recently done a 4-day workshop with our members at the Financial Traders Hub, which consisted of a watchlist building exercise for Q1 2025. If you want access to the recordings of those sessions, there's a link in the description below. And also there's an email address where you can get in touch with us if you want to discuss your education further. I would highly recommend you get access to these recordings because they are highly relevant to whatever's happening in financial markets now. In the workshops, we discuss trade ideas, different types of trades, trade idea sources, how to diversify portfolios, and we discuss relevant themes that are likely to play out in Q1 and beyond in 2025. So guys, if you want to get a taste of all the discussions within the Financial Traders Hub, this is the place for you to go. You'll instantly understand the quality of the education, the depth, breadth, and relevance of everything that we are discussing at the moment. And finally, if you're not subscribed to the channel, make sure you hit that subscribe button. There's a pipeline of amazing trading videos that are coming in 2025. You don't want to miss that. Let's come back to this trade. Strap in, pay close attention, and if you have any questions, do write to me in the comments section. I'll get back to you as soon as I can. Let's review this famous trade where we shorted AI using put options and made 996% in the space of 6 weeks. Before that, guys, everything discussed here is not financial advice. It's purely for educational basis. Do read the disclaimer. Also, all the materials discussed here are intellectual properties of the Financial Traders Hub. So what does C3.ai do? C3.ai helps enterprises with digital transformation and AI solution implementations. In the first week of December, we shorted it while it was trading around $45 just before earnings, and eventually closed the trade on the 18th of January when the stock was trading at $32. That's a drop of 29% in the space of 6 weeks. So what was the thesis about? Basically, we'll break it down in 2 sections. One is company-specific fundamentals, and the second one will be around macro factors that contributed to the trade. So AI is a company that has high stock-based compensation, and at the moment it's still loss-making and projected to keep making losses in the future. So this is a company that really needs revenue growth to keep the equity trading higher. However, what we were saying is that revenue growth was not sufficient enough to be able to sustain the valuation of the company. And that's despite multiple trials underway and a lot of announcement of partnerships. Also, to contribute to this trade, there was a lot of hype from this whole AI trend. Well, I'm not saying AI is a hype. I truly believe AI is a game changer and it's going to be here for many, many years. However, we have to also understand when stocks just overextend based on hype. And in this case, this company actually overextended. Once the election results were out, a lot of companies were beneficiary of flows that are not necessarily buying on the basis of fundamentals. We call these indiscriminate buying. So that would come in the form of passive flows like ETFs and so on. And then you always have how would we call them? The madmen, the mad people out there who actually just buy everything related to a specific theme and just bid the stock high. Just for perspective, the stock moved from 25 all the way to 45 in the matter of, I think, 4 weeks. So that's quite radical. And there was very little in terms of news flow, if any. I think there was only 1 or 2 good announcements. One of them was partnership with Microsoft Asia ecosystem, which is a good development, but it doesn't really impact the fundamentals, in a manner that investors can really appreciate it. Like I've discussed, this is a company that badly needs revenue growth, but we were not necessarily seeing that actually happening within the financials of the company. Also, once earnings were underway, I think everyone was watching out for a meaningful revenue guidance upgrade, which did not happen. So management kept their earlier revenue guidance and did not necessarily raise revenue outlook in the future. And that's despite them being bullish on all the initiatives that they're announcing with the company, all the partnerships and everything. If they are this bullish, why are we not seeing revenue growth being upgraded? I think these two should tie in together, and having one but not the other, I think that raises a lot of questions. So just to put the nail into the coffin, I think what also happened was they widened the lower end of EPS guidance. So no revenue guidance upgrade, but at the same time, they're telling the market that the range of outcomes when it comes to EPS, and keep in mind, this is a loss-making company. They were making the range of outcomes even worse. And that definitely creates a lot of worries for existing investors. So shareholders were not only concerned about the future range of EPS being even worse than previously thought of, but also a lot of the trials previously announced were not actually converting into bookings, which eventually convert into revenue growth. So we're looking at a company here that's clearly a long duration asset. It's loss making. Management is getting a lot of stock-based compensation, which is highly dilutive for the equity of the company. What do you need to counter these dilutive forces? Revenue growth that eventually creates a lot of value for the equity and counterbalances the stock-based compensation. What were we not seeing? Revenue growth that's enough to be able to override all these negative forces. So we got into a situation that was really hyped up with the elections, AI and whatnot. And at the same time, once earnings were out, investors got a taste of the truth and they realized that there was no revenue growth upgrade. So what happened to the stock? Of course, it started selling off. It took a couple of days to sell off. It was highly volatile. So it moved from 45 to 47 and then down to 35 and then opened the next day at like 45 again or 43. So in one day post earnings, it traded from 35 to 47, which is a massive range in itself. To compound all of this, what actually made the thesis work even better was related to the macro factors that were unfolding in the markets. So at the same time, the Fed had announced that they might be on track to pause interest rate cuts. So a long duration asset badly needs revenue growth, but it also badly needs interest rates to go lower. So combination of these two factors, the fundamentals and the macro not aligning, created a perfect opportunity for the stock to sell off from where the hype had taken it up to. So what were we saying? If you pull up a chart of the US 10-year rates, you would see that it was rallying, especially after the Fed meeting, which happened to be, I think, a couple of days before AI announced its earnings. And that was definitely putting significant downwards pressure on AI. So now let's discuss the trail of events for this particular trade idea. At the Financial Traders Hub, we've got a Discord server where we discuss everything that's happening in the markets live in real time with our members. So I'll show you the trail of events for the AI trade. On the 5th of September, I started discussing it in the Discord server. At that point in time, I realized that the market was becoming more and more critical of SaaS, tech, and AI plays. So the market was no longer giving that much of benefit of doubt to these types of companies. There were many reasons behind it. One of them being reinflation being a risk in the market from a macro perspective, but also the fundamentals of these companies were not actually improving that significantly. So valuations were probably a little bit overextended on many names. It had been like that for months, but now the market was starting to pay attention. So we are still very early here. We're on the 5th of September. And if we put the trade right there and then, we'd be wrong because the stock just kept rallying through all the way till December. So timing is extremely important. However, in order to get the timing right, you need to be prepared for the trade. You need to have enough time to have discussed it, analyzed it, and figured out what's going to be your trading strategy. So as you can see in the Discord server, we're basically starting to look at what the company does and why is it that this could be a potential short opportunity. And then a couple of months later, we come back to this trade idea again on the 21st of November. We start outlining the thesis, looking at the financials and earnings presentation of the company. We look at the KPIs and we're trying to figure out what's happening to the fundamentals within this company. But at the end of the day, we still realized that the timing was off and we decided to stay patient. At that point in time, it was around the post-election results and the stock was just rallying indiscriminately. So sure, we're contrarian here, but we're not one to argue with the market when the stock is just rallying for no good reason. So we decided to stay on the sidelines and wait for a better entry price as a short. In the meantime, we keep discussing the thesis. We add a little bit more detail to it and start considering the risk here. If you look at the Discord server, we're looking at the timelines and saying it's going to report in 19 days and so on. And we're having a discussion around the stock-based compensation and why is it material? Why is it that this could create a big downside pressure for the share price? And also now we're starting to get into the skin of a trader and discussing how to time the trade given that we are contrarians. And also given that the levels of volatility associated with this stock are pretty high. So as a trader, we're starting to establish our trading strategy and trying to figure out how do we structure the trade to take into consideration all these different factors which might not be in our favor. On the 26th of November, we start doing a bit of a more thorough risk assessment. We start discussing trade structuring a little bit. And if you'll see in the Discord server, so we've got one of our members, Darren, who shorted AI in the past quite successfully. So he was saying that this might be a good trade. And at the time, I think AI was trading around 30. And I thought it could pull back to 20 after earnings. And that would give us a very good return on investment. So you see my comment there, right? If it works, we need to get paid big, right? That's the mindset of a trader because you're always seeking asymmetry. You bet one to make a lot more than one, right? As you can see, another member, Bhavan, so he's outlining that this is a risky thesis. And I'm like, yep, absolutely, totally risky, but we need to understand what we're getting into here, right? If we can find a trade structure where we bet one, if we are right, we get 5, if we are wrong, we lose the one. I think that's a good payoff and good and probably a good trade to put into our portfolio. And also at the time, the price action was showing some weakness and also happening at high trading volumes. And meanwhile, as we're discussing this whole trade thesis, the US 10-year rates are just creeping upwards. And I did mention earlier that this is a big headwind for these types of stocks, right? At the same time, what we're trying to figure out in the Discord server is a little bit of technical analysis. This is a minor part of what we do, but we're trying to understand the price action in the past and what's probably going to happen next based on the stock chart itself. So we're trying to identify patterns that would show that the trend upwards is weakening. We're definitely starting to see exhaustion pattern in the stock. But keep in mind, the stock rallies even further from here. I think it rallies from 30 to 45 eventually. This is the nature of the stock that you're dealing with, and you have to appreciate it, you have to acknowledge it. And as you're outlining your trade structure and trading strategy, these have to be at the forefront of everything that you're doing. And finally, on the 9th of December, so earnings were after market close. During the trading session, we initiated the position. So you'll see my comments on the 9th of December, where we're discussing, that I've pulled the trigger, then earnings are out. And eventually the stock is up 5% after earnings. And then the next day, the stock opens a little bit higher, gives back all the gains. So during the trading session after earnings, the stock goes from 47 all the way down to 35 and then probably closes in the middle. But the trading range is enormous. Imagine going from 47 to 35. Imagine the kind of implied volatility in these puts. So as I mentioned before, the implied volatility in the puts would be extremely high, and there was a very good reason for this. A lot of times beginners think that they need to find options that have very low implied volatility because from their perspective, that's a cheap option that gives them a good way to play a particular situation. It might be right, but in most cases, if there is a situation at play, the implied volatility would be relatively high, indicating that the market makers think that the stock could move a lot here. So sure, I'm not saying always buy options with high implied volatility or low implied volatility. Actually, that's not even a consideration before you start putting a trade, right? The fundamentals of the trade have to make sense first. And then later on, you look at things like implied volatility and so on in your trade structuring. So that's how seasoned traders do it compared with beginner traders who are always looking for cheap stocks or cheap options to be able to express their views. And in so doing, they are missing or not focusing enough on the fundamentals of the trade itself. If you get the fundamentals of the trade right, then the rest is not actually that difficult, right? So that's telltale signs of beginner traders always focusing on the wrong things and thinking that this is how they get an edge, right? By picking up something that looks cheap and maybe selling something that looks expensive. And they don't realize that there are millions of market participants that are 10 times more experienced, more intelligent than them. If this was actually the trade to do, the beginner traders would not be the first to do that, right? So that's a little bit of a mindset change that needs to happen with beginner traders as they are evolving and becoming better and better as traders. And it's a lot of what we discuss in the Discord server too, right? It takes a lot to become a seasoned trader. It takes a lot to be able to find these situations, structure them, play them so well. But it's certainly doable. And there are lots of skills, lots of psychological factors that you need to take into consideration. And also, a lot of good habits that you have to inculcate right in the beginning of your trading journey. Having the wrong habits, the wrong beliefs, psychological limiting factors, and all of this will just set you back a lot on your trading journey. Either you lose a lot of money, or you'll lose a lot of money and you'll get so discouraged that you will never continue the journey to be able to, rise and up your level as a trader. But let's get back to this trade, right? So on the 9th of December, we initiated the position before earnings were announced. And at the time, the stock is trading around, I think, $43 to $45. And then on the 18th of December, we started trading around the position just to add value to it. So we're taking advantage of high volatility with this stock to add more value to our position. I'll show it in the next few slides. I'll give you a detailed breakdown of all the trades that we made and the reasoning behind it. But this is basically just a summary of all the trades that we've done, right? We'll go into a bit more details later. On the 18th of January, we exited the position with a total return on investment of 996%. Yes, 996%. What does that mean? Think about it, right? You don't need to be a mathematical genius to realize what 996% return on capital means. It basically means that you've risked $100 to make $996 in profit. That's enormous. That's an enormous return. You don't hear of that in financial markets very often, right? But this is something that if you learn how to do it, it's not going to be like a one in a lifetime event. It will happen quite frequently, not every week, not every month, but it will happen a couple of times, maybe in a year, and a bit more often if you know what you're doing in the financial markets, right? So you'll see in the Discord server, we're having a little bit of a victory lap now, right? So all the members are like excited, elated, positively shocked. It's like surreal for a lot of these members, because as beginner traders, for them to be able to see the whole journey from start to finish and see all the different milestones of this trade being outlined to them in real time, it's phenomenal. It's sensational, right? Imagine what that does to a beginner trader who still doesn't have the right belief system around the market, doesn't really believe that you can make money out of the financial markets, believes all the nonsense out there that you cannot beat the market in the long term, and if these opportunities were available, they'd be arbitraged away, and all of that. There's like a whole campaign out there to dumb down people and make them believe things that are completely untrue about financial markets. Sure, it takes a lot of skill. It takes a different mindset. It takes a different way of looking at financial markets to be able to achieve these types of returns. But it's certainly true. It's in front of you. Every snapshot is time-stamped. These members are real. They exist. I'm not going into Photoshop and inventing stuff, right? I'll even ask a few of them to comment on the YouTube video so you know that they exist. But jokes aside, right? What I'm showcasing here is a live trade happening in real time, showing you the different stages of the thesis development, how you determine whether the trade is ready to go, and eventually when you play it out, how you trade around it, what's your strategy, what's your structuring in order to get these types of enormous returns. And keep in mind, that's for a stock that's highly volatile. This is not a situation that you could have shorted shares, because it's so volatile that you'll short it at, let's say, $40. The stock will go to 47, and it's gone above your stop loss, and you'd be stopped out of the trade, make losses a few times, get whipsawed, and you'll never be able to play these types of trades successfully with shares or CFDs. And that's the beauty of options, right? Because once you've got a trading strategy and you've structured the trade well, you know exactly what are your payoffs. You know exactly when you need to do something. You know exactly when you just need to sit on your hands and do nothing and just focus on doing research, finding other situations in the market. There's actually, if you think about it, it's not really that busy. People think that trading is like extremely busy. You're on your keyboard executing trades every single day. Actually, that's the minority of what we do. A lot of our time is spent on research and finding situations, thinking around these things. And then execution is just like, takes like a minute to put in an order, and that's about it. Then you log out from your platform, you go back to your Excel sheets, you log your stuff. The brokerage platform, you don't hang out there. There's nothing exciting happening there, right? So this is basically what I wanted to show you guys before we get into the actual trading strategy and all the different trades that we took into this situation. It's a bit of a surreal moment, right? For our Discord server members, for yourself, right? As you're watching this video, it's kind of unbelievable. It's too good to be real, right? Someone making 996% return on investment in the space of 6 weeks, unheard of, right? If you know someone else who's done this, great. You should learn from that guy because that person definitely knows what they're doing. And this is the benefit of the Discord server of the Financial Traders Hub. All the members get to see these types of trades. Every single day we're discussing these types of trades, long, shorts, how do you diversify your portfolio? How do you think about these situations happening in the market? Something is selling off. What does that mean? We're always positioned one step ahead of the market. I mean, in this case, you would have seen, right? We started looking at this situation on the 5th of September, all the way through November. And then eventually we pull the trigger on the 9th of December, right? So there's a lot of preparation that goes into getting these trades right with the right timing. Sometimes it's quicker, sometimes it takes a little bit more time. You just have to wait for the market to give you an opportunity. Before we move on to the actual trading strategy itself, let me also go through this slide because this is very important. So one of our members, Haider, he was asking me a few questions around the stock-based compensation. So his question was basically twofold. One is, how do you determine what level of stock-based compensation is out of whack or reasonable? What do you compare that against? Do you compare it against revenue or some measure of cash flow? It's a very valid question, right? And also, the second part of his question was around, I mean, this is definitely a situation that everyone knows about, right? It's not like it's new information. People know about this stock-based compensation situation for like months and even years. Why is it that now it's a catalyst, basically, right? And also, his question was highly valid, right? It's like, why are shareholders not calling out management? Like this is staring at everyone in their faces, and they still don't say anything about it, right? So what follows is my explanation. So where I'm basically saying there's no like established metric. What you need to understand is you're trying to figure out whether the operations of the business are generating value for the equity portion or the equity holders, right? So typically you tend to compare the stock-based compensation versus a metric of cash flow, maybe like free cash flow. It could depend on the situation you're looking at, but that's a good bet, right? And also just discussing a little bit about the situation when it comes to management and whether they get called out by shareholders or whether they get any pressures to rein in the stock-based compensation. And finally, I also discuss a little bit of the accounting methodology when it comes to treating stock-based compensation. So I'm not going to go too much into details here. Depending on the accounting standards that you're looking at, one of them does not consider stock-based compensation as an actual expense for the company, which I think is a little bit ridiculous, right? Because if you're paying your staff members with shares or partly with shares and not accounting that as an expense, right, in in producing the goods and services that the company will eventually ship to their customers, I think that's a little bit crazy, right? So this is what we were discussing in the Discord server. How do you identify future situations like this? And Hader is spot on, right? He's like, yeah, I've seen the AI situation. Now I need to be able to find the next types of trades that have these similar types of characteristics, because I don't want to stop at AI itself, right? There must be many situations in the market that have almost the same kind of characteristics. And, you know, he's trying to become independent on his own in thinking about these situations and finding his own opportunity in the space, which is amazing, right? So this kind of awakening moment that happens within the Discord server is actually expanding people's mind, and now they are starting to think about, okay, so how can I carve out my own opportunity within the financial market space? And that's a great trait to have. I absolutely love it when people start thinking along those lines, because I know what's going to happen next. These guys are going to come up with their own ideas, and a lot of these ideas would be near ready to execute in the portfolio and would be big winners. I've seen this so many times in the past, right? I know exactly what type of behavior lead to people furthering their journey as a trader, and also what type of behaviors would just be like someone fizzling out and you won't hear of them in a couple of months, right? So moving on, just outlining the trading strategy now. What I've got here is a summary of the trade, so you put everything into perspective. I'm using 2 contracts here just for illustration. The actual trade was a lot more, right? So as you can see, there are a number of long and short trades that we had executed, and on different with different expiry dates. And in the next few slides, I'll also indicate on which dates these executions happen and for what reason. But as a summary, you can see the net cost of the trades were $1.88 per contract, and then the net profit was eventually 18.72, which gives us a 996% return on investment. So you could have participated in this trade with a minimum of, let's say, $188. Actually, you need a little bit more, right? 188 is just the net cost. So let's say you probably would need around $400 to play this trade at a minimum, right? And that would give you a fantastic return on investment, right? And the beauty of options trading is you could do it with 2 contracts, you could do it with 5, 10, 20, 30, 50, 100. It's highly scalable. So these numbers, you just multiply them by number of contracts that you're using. And the strategy is almost the same, right? Because even at 50 contracts, you still have the right level of liquidity to be able to trade these options and do them at the same prices. It's not going to make a big difference, right? So that's the beauty of options. Once you've mastered it, then it's highly scalable. And you can trade in large sizes too once you know what you're doing. Once you know how to manage risk, it's no longer that scary because you know exactly what to do next if something happens in the market, right? I'll show you in the next few slides as to how I take these types of situations, how I outline the trading strategy, how I define the trading actions to do based on what the market is doing, how I take advantage of the volatility of the stock in the market, and also my core focus at all points in time is to try to de-risk the trade from the moment I've put it on. This will become very obvious as we go through the next few slides. So, in short, the trading strategy, while structuring the trade, we acknowledge the following. The stock has very high implied volatility. Therefore, we tailored the trading strategy accordingly to give us the best chance to take advantage of such high volatility. The stock was also experiencing a strong rally. It went from $25 to more than $45 in the space of only 4 weeks. That's a phenomenal rally. We were contrarians here, but certainly not one to argue with the price action in the market. However, we were expecting earnings to open shareholders' eyes and bring back sanity to the market. Okay, keep these in mind. Now let's look at the detailed trade breakdown. On the 9th of December, the stock price is around $43 pre-earnings. We go in the market, we buy 2 puts with strike $40, so we're not going too far out of the money. Spot price is $43, we buy the puts at $40 with an expiry on the 24th of January 2025. Actually, in the options market, everything is denominated by 100 times, right? So every number that you see here, you need to multiply it by 100. So actually, 2 put options would cost us $400, right? It's just a little bit of a technicality to explain, right? If you've traded options, you would know exactly what I mean. And then we also go in the market and we sell 2 puts with strike $40 with an earlier expiry on the 13th of December 2025. For this, we receive $259 per put contract, right? So we've got our position now, we're waiting for earnings. Earnings happen, and then on the next day, post earnings, the share goes to $45. During that day, it trades with a very high range. It goes from 47 to 35 and ends up in the mid 40s, right? What do we do there? We buy back those shorted put options at 29 cents. So basically, we got a credit of $259 per contract. Then we basically buy back those contracts for $29, and that gives us a little bit of a profit on that short leg. So on the 10th of December, I am only long 2 put options with strike 40 expiring on the 24th Jan 2025. So basically what I've done here is I've used the rally in the stock to buy back my short leg and basically reduce my net cost in this trade, right? So remember my comment about trying to de-risk the trade as soon as possible, and also taking advantage of volatility in the market. So this is a clear-cut case of the market is not yet agreeing with me in terms of price action, but it's giving me a fantastic trading opportunity, right? Which I definitely take advantage of. On the 12th of December, now the stock starts falling. The stock price is around $37.5. We go in the market, sell 2 puts with strike $33 with expiry 24th January 2025, and we get $106 per contract, right? So remember, I came into the 12th of December with 2 long puts, and now I'm shorting 2 puts with the same expiry as my long, but with a lower strike price of 33 to establish a bear put spread structure. So I've got what we call a bear put structure or vertical spread, which is in the range of $40 and $33, right? And then basically what I'm doing here is the stock starts to collapse, right? So I'm using the lower spot price to sell puts to establish the bear put spread and get a higher premium for those puts, right? If I had done this at the beginning of the trade, I would not be getting $106 per contract, right? So as the spot price is falling, then I get a lot more premium for these puts with strike $33. And then finally, on the 18th December, the spot price rises to $42. So remember, we said that it's a highly volatile stock. As you can see on this chart over here, right? You can go on TradingView and just play around with the chart again and test all these different dates and see how the trade is unfolding. But basically, you can see it's a highly volatile stock, right? It's moving a lot, especially after earnings. So earnings is around here, and the red arrow is basically where we entered the trade. The green arrow is where we took profits, and then in between, there are a number of trading actions that we've done based on whether the stock was going up or down, right? So on the 18th of December, the stock rallies back to $42, right? What do? We buy one put, strike $40 with expiry 24th Jan 2025 at $210 per contract. So what is this? What's the aim of this? We're basically using the rally in the stock to increase our short exposure. In other words, we want to get more put contracts, right? By that stage, I had a lot more conviction that the stock will eventually collapse because the US 10-year yield was rallying even higher and the stock was showing a lot of weakness in its price action. So even if the spot price had risen to 42, someone could say maybe, that invalidates your trade because the market is not really selling off the stock. But if you know how to read the financial markets, both from a company-specific price action and also from a macro perspective, you would be able to figure out that there was increasingly more weakness in the stock and its price action. And then on the 18th of December, I basically buy back my two short puts with strike $33, which were expiring on the 24th of Jan 2025. And I pay $34 per contract here. So basically I get a decent profit from closing my short leg on the puts. By this stage, I'm long only 3 puts with strike $40 expiring on the 24th Jan 2025. And the average cost is around $336 per contract, right? So I managed to buy one extra put at a lower price, which was $210 compared to the initial $4 that I paid before earnings. And that lowered the average price for my position to $3.36 or $336 per contract. And then on the 20th of December, so basically 2 days later, the stock actually collapses to $34. This is where I know that the trade is about to work. It's going to work now and it's going to work a lot more, right? So what do? I sell one put with strike $40 expiring 24th of Jan 2025 at $6.33. Why was I doing this? I was basically selling that extra short exposure that I had taken a couple of days ago. So this is basically me taking profits partially. We're in a situation that's highly volatile. So at any point in time, you could give back all the gains. And therefore, you have to start taking profits as they emerge, right? So by this stage, I think the profit that I took had already kind of made sure that I would be break even if the trade doesn't work out. So the rest of it is basically me riding the markets for free. And if the stock went back to, let's say, $45, I would basically not lose anything because I had taken profits partially. And those partial profits were similar to what I had spent on the entire trade. That's the beauty of trading options. If you know what you're doing and you do this as a real professional, it's a game changer, right? You can take advantage of these situations in markets so well. Moving on the 9th of January, basically the spot price is even lower, goes to 32.5. Then I go in the market, sell 2 more puts with strike $30. So basically I'm setting a new vertical trade. So remember, I had 3 long puts. I sold one of them. Now I've got 2 long puts naked, right? And basically now on the 9th of January, as the stock price has come back even lower, expiry is on the 24th of January. So I haven't got much time. And therefore I decide to set up my vertical trade there. Because the stock price is 32, close to 30, I get a relatively good premium as I sell these put options, right? So basically I'm setting up the bear put spread again as the stock is falling. And then on the 16th of January, the spot price is around 31.8. I basically buy back my shorts. So I buy back 2 puts with strike $30. I pay $22 per contract, so I make a little bit of a profit on that leg too. The reason for doing this is basically that We're very close to expiry now. Expiry is on the 24th of January, and anything can happen in between, right? And there was the Trump inauguration on the 20th, so I didn't really want to take more risk with whatever could happen around the inaugurations. Knowing Trump, he could say something, or knowing the market, they could just become bullish on everything, and it just destroys the trade itself. So as a trader, you have to be aware of all these things, and as the profits emerge, you have to take them partially, and then let your trade also work, and also determine when is the time to unwind the whole thing. So basically on the 16th of January, I'm unwinding the short leg, take a little bit of profit, and then finally on the 18th of January, the stock rallies a little bit. It goes to 32, 32.3 or something. That's basically where I unwind my long puts, and I get $8 per contract. This is basically me taking profits fully and then going to the Discord server and doing my victory lap with the whole team, right? Like I mentioned, right, we wanted to exit the trade before Trump's inauguration to crystallize our profits and protect ourselves against a short-lived, irrational rally. You've got to take all of this into consideration, because if the stock rallies like 5-10%, that in itself will just destroy your return on investment. And there's not a lot of catalyst in the last few days of the trade, right? So there's no point of waiting. In this case, waiting would just have made the return on investment even worse, because I think by the 24th of Jan, the stock was trading around $34, $35, right? So, it was definitely the right decision to make by taking profits a little bit early and not going neck to neck, on the last day of expiry to take profits. So this is the mindset of a seasoned trader, right? We're not wanting to squeeze out every single cent in the trade, because being focused on that would have caused us to lose a lot of our unrealized gains, because we want this stock to go even lower than 30, 28, 25 to look like an absolute hero. But at 996%, you're already there, right? At the peak of this trade, the P&L, the unrealized P&L, was 1,300 in terms of return on investment. So if I had closed the trade back then, because the share price even went slightly below 30 at some point, if I had closed the trade there, it would not have been 996, it would have been 1,300. So, between these two, there's not much of a difference, right? At the end of the day, unrealized profit means nothing. You need to book these profits, and that's what matters, right? This is the real money. So guys, I hope you found the video insightful. Feel free to write to me in the comments. You can email me, and check out what we've got at the Financial Traders Hub using the links in the description below. Remember, do get yourself these recordings for the workshop session. Your mind will be blown. With that, this is it from me, guys. Thanks for watching.